or maybe call them as well. So anyhow, make a long story short, thank you again to Angie and Jenny for coming on, for being our trusted partners in the title side of things. So thanks guys for being here. I want to just kind of go over kind of where our rates are at. We had a nice little dip in rates, and then we had a little bit of a crazy drop in the bond markets, which made rates spike a little bit. So I'm going to share a little bit about where we were and where we are, and then we can kind of go from there. So here is the markets today. This is that dip in the bond market that we saw. Again, when the 30-year bonds have a bad day and go down, rates go up. So, and then this was last week. We really are trying to bounce. And if you see today, this little area right here, we actually went above this level of resistance and broke through this level of resistance, but then bounced back. So these levels of resistance, they're called that because it's tough to break through and it's tough to stay there. So we're going to watch that carefully, because right now rates are slightly better than what they closed on Friday at. So we're going to just continue to watch that. We're up 11 basis points for the day. So what that means, a rate that costs 0 points now gives you a lender credit of 0.11 discount points. So rates don't change very much, the cost does, and that pushes you to the next level. So as far as what's happening, the reason we saw this huge drop in bonds is we saw a lot of good data coming from earnings from companies, a lot of good data coming from the number of people entering back into the workforce, and a lot of the inflation fears were kind of shrugged off. And then they said they were going to be putting the tapering on the shelf, so to speak, until later on in the year. Tapering is where they're slowing down the mortgage-backed securities, the purchase of mortgage-backed securities. So that all was good for the markets, bad for mortgage-backed securities, which is bad for rates. But then we got this rebound, and we bounced off this floor right here, which is, it's amazing how it does that. That resistance, you boing, you bounce right off, and then boing, you bounce right back down. So this, we're going to probably be playing ping pong in this range for a little while. We have some bond auctions this week, so we're going to be watching that carefully. Some good news, we had some, the wood futures are down 50% off cost. So that means the materials are getting a little bit cheaper. So that's always a good thing. And you're going to notice that when you go to Home Depot, a lot of the goods are still a little bit cheaper now. There's quite a few things that are going to have an issue, and that's anything that has to do with chips are still going to have issues. So those are going to continue to have a little bit of inflationary. But like I said, it's transitory, and that's a good thing. So again, we're going to keep rates. Rates are going to be low for a long time. We're just wanting to make sure we're managing it correctly so we know when to lock our customers. So if a customer came into me on Tuesday of last week and said, hey, I want to lock, I would have said no, because we were on our way bouncing upward from a low point. And then I'm going to watch it carefully. We may want to lock some if we start bouncing back the other direction. That's where we can save customers. We can save customers even more by just watching these markets. So one of the topic of today is going to be, what is the difference between all of these pre-qualifications that you get? How to really look at them and know what really is going on with these pre-qualifications. So I'm going to stop sharing, and I'm just going to, well, I'm actually going to share with you the little summary I created here. All right, so pre-qualifications, what does it mean? Every mortgage company has a different version of what a true pre-qualification is. I'm going to start with the scariest. First off, a pre-qualification should be the total vetting of the customer to ensure that when they get in your car, they're able to get a mortgage. That's what a pre-qualification should be. There's a lot of junk out there, so I want to go over kind of what they are and the behind the scenes on how they work. First off, if you get this version, which I call the scariest, I'm going to put a little bit of a red on it. There you go. That's the scariest version. This is what those at banks. And you can properly vet your customers to see how they got the pre-qualification. If you go to Chase, Online Mortgage, or Wells, you can go through a mini loan application. It asks you, how long have you been in business, or how long have you been working? How long have you been there? What is your credit score range? And then that gives you a range to choose from. And then it says what you're qualified for in a generic little breakdown. It doesn't run your credit. It just assumes you know what your credit scores are, and it assumes you know what your debts are. It's really bad. So if you ever get one of those online, the ones they create online, they're kind of scary. So those I would be very, very wary of. Again, it's just an online application, credit scores manually entered, there's no documentation received, and then a basic pre-qualification is issued where you can print it off from online, and you never talk to anybody. Those are the scariest because it's garbage in, garbage out. If you're self-employed and you put that you're a W-2 employee because you pay yourself a W-2, you can go through this and get an approval where you might not even be close to getting an approval. So very scary. So anytime you hear from, if they're a bank, pre-qualification that you're getting from a buyer or from a seller for their buyer on your listing, and just be wary and ask the right questions to see if they've actually spoken to somebody, if the credit was actually pulled. But that's step one. The next type of pre-qualification is when you have the buyers talk to a loan officer and they do a traditional loan officer activity, which take an application and then they run credit. So let me give you an example here. If I have an FHA buyer and I take their application, I go through everything and I do it right. I do everything right on the application. I ask them where they've worked the last couple of years. Is there any gaps of employment? What's going on with their assets? Where are those assets coming from? Are they seasoned? And I do a proper application. And then I run credit and I see they have a 640 credit score. Well, FHA doesn't really have a credit score rating, and most companies allow 620 or higher, even though we don't have a requirement on credit score. But a 640 should be fine. It fits the guidelines. Anything over 620, most lenders will accept. So they're teachers, so you move forward, everything's good, you issue the basic pre-qualification, and then they find a property, you go under contract, and then about a week or two in, the loan officer calls and said, I'm not sure why, but I can't get an automated approval. And we're getting an automated approval is saying, no, we're getting a refer with caution. I don't know if any of you have ever heard that, but basically what that means is the loan officer never ran the loan through the desktop underwriter, which has a credit risk analysis along with the assets and the overall risk of the overall transaction. And it gives a grade, so to speak, of pass or fail. If it fails because the overall risk, regardless if the customer fits guidelines or not, you could get a loan declined, even though their credit scores are enough, they have the down payment enough, because the overall risk might not be there. So if you've ever had a loan blow up because the loan officer did not run automated underwriting first, this is why. Because it fits the guidelines, but it's too risky. So this, again, this is scary. Never, ever accept a pre-qualification if it hasn't had an automated underwriting behind it. Very important to ask those questions. Now, that might sound like it's pretty good, but there's no documentation received. So in this scenario, they have the automated underwriting. I'm sorry, without underwriting. Let's go to the next one. Sorry, this is a bad one. We're going to the next one. They have an automated underwriting. So we're good. They have it. It's been credit analyzed based on what you've put into the application. But is what you put into the application really accurate? And that's a part that's the scary part behind this one. So in this one, we've taken an application, we've run their credit, we've analyzed their credit, we've run it through the system, and we have an automated overall risk analysis that is positive. So we issue a pre-qualification, we send out the needs list, but nothing has ever been received. This is another version of a pre-qualification. Again, because no documentation has been received, this has not been validated. So these are probably the three most popular pre-qualifications that are done, which is kind of scary. Again, no documentation is received, especially if they're self-employed. There's no tax return, and those can blow up every deal. very quickly because of how they file and what they truly show as income. But if no documentation is received, this is just, we hope that everything is good. It should be good based on what they've told us, but that's just as good as anything else. I mean, what do we always say? Buyers are liars. So we never know if it's truly true or not until we get the documentation. So the fourth version of a pre-qualification is loan officers taking a good application, underwriting, automated underwriting is done, the credit has been run, the basic pre-qualification is issued, and the documentation is received and reviewed by the loan officer. Now, this is when you've got an Arizona pre-qualification form that is completely filled out. All of the boxes are checked, that we have everything, because the loan officer is where the buck stops. It doesn't go to underwriting to have them review for the most part. It usually stops at the loan officer and their review of the actual documentation. Now, most loan officers have never been underwriters, so they don't know all of the details for the most part. I would say a lot of them, some of them do, but a lot of them don't know the details regarding how to even read tax returns, how to look at if there's debts and payable that are due in less than 12 months on their tax returns. What do you even, how do you count that in their income? Things like that. So this is the loan officer's review of it. It still has some holes in it, unless they're standard W-2s that are really easy to run, but it still has holes. And here's some of those holes. If you are an hourly employee and you looked at their most recent pay stub, and in the last 2 weeks, they made $2,500 for that 2 weeks, you might not have seen that a month before that, they only worked 20 hours because now they were cut to part-time, or their hourly wage, their hours aren't regulatory anymore. They're not regulated, and they're not continuous, and they're not, come on. They're just not, what's the best word I'm looking for? Consistent, that's the word I'm looking for. They're not consistent. So that's where a verification of employment comes in, and a VOE can kill a deal, because what they have been making, maybe they're not making anymore, or they're not working the same hours based on what they've proven in the past. So that's where underwriting comes in. So this, I would say, is a good pre-qualification if we have all the documents, but the best pre-qualification is this one right here. This is a normal application taken, automated underwriting has been completed, credit has been run, the basic pre-qualification is issued, but all of the documentation has been reviewed as well. And then a second set of eyes by the actual underwriter is reviewed. During this process with an underwriter, it's not just them looking at it. We send out a verification of employment to the employer to make sure that their hours that they're working are correct based on what their current trend is and what that trend, if it's going to continue or not, will be. Because there's questions on that said, are they going to be continued at full-time employment? Are they part-time? And stuff like that could kill a deal. And also, tax returns are analyzed this way. So when you're looking at pre-qualifications, not all pre-qualifications are the same. They are completely different in many, many different ways. The only way to know for sure for self-employed is if those tax returns are fully vetted, because you and I both know, we've all seen loans blow up in the middle of a transaction because they don't qualify 3 weeks into it, because they finally got all pages of their documents for their tax returns and now they don't qualify. It's scary when that happens. It's because somebody accepted one of these pre-qualifications up here and hoped. They lived on hope. And yes, a lot of times they go through and everyone's all, oh, thank God that worked. We don't want to live like that. Not at all. So we want to be careful when we're accepting pre-qualifications and when we're giving our faith on a pre-qualification as to how strong these borrowers are, by what we actually accept, and then go from there. So I want to take some questions on some of these different pre-qualifications that come through. The scary thing is they're all portrayed on one piece of paper, and that's the Arizona pre-qualification form. The Arizona pre-qualification form does not have any box on there that says the loan has been approved by an actual underwriter. It doesn't have a box on there that says desktop underwriting has been completed and it's approved and risk analysis is done. It just says, have we seen the documents? So it's important that we properly vet these different types of pre-qualifications that we're seeing. Another thing, if you receive a pre-qualification that is not on an Arizona form, I wouldn't even accept it. I would send it back and say, please have lender update the form to match the Arizona pre-qualification. 9 times out of 10, that loan officer is an out-of-state loan officer and they just don't understand, which could cause some serious problems for you as well. So I want to open up questions and go over the different types of pre-qualifications that are out there and really make sure you understand the difference between, and this is the key, the difference between one that's been vetted by a loan officer that hasn't been run through automated underwriting, one that has been run through automated underwriting but no documents, one that the loan officer has received everything but that hasn't been reviewed by underwriting, and then the automated, the full process where it's all the way through underwriting. It makes a huge deal when you're looking at different buyers on your listings, because it's really scary how some lenders are issuing these pre-qualifications. I've seen it all the time. I've seen copies of letters from Chase on their online printed forms that say they're qualified and their credit scores are in the 500s because they just guess in that range. So I want to make sure you guys are armed and dangerous when it comes to vetting these pre-qualifications that you're getting, and make sure we're, asking the right questions. Any questions? Raise your hand, take yourself off mute, whatever you want to do, because we don't have a huge group today. And ask away, because I know that if you've seen these pre-qualifications out there, you know the pain of getting a loan denied halfway through. And usually that can be fixed just by making sure the proper pre-qualification is accepted and the documentation is in for those buyers. So I went through a lot right there. I'm going to send that little breakdown of the different pre-qualification stages. And again, every stage on here can be completed on the Arizona Association of Realtors form. I can send out an AAR form and have every single one of those fields filled out, and you might not know the difference. So you might not know that the credit hasn't been run yet. Who knows? I mean, there's boxes on there that even show that the lender hasn't even spoken to, which is even scarier. But again, I want to be here a resource for you to help you decipher through the pre-qualifications that you're getting. And if you have an offer that you're getting on a listing and you want me to make sure that that pre-qualification is secure, I'm more than happy to talk to the actual borrower and even the buyer's agent that submitted that offer. So does anyone have any questions on the types of pre-qualifications and the levels that are out there to make sure that you know and can ask the proper questions?
Yeah, I'm going to ask you a question, Sean. Which kind of pre-qual do you issue?
There you go. So the True Proof program is what we offer. Essentially what we do is we know that buyers sometimes come to us with a property they want to see, right? It happens to all of us. So what do you do in that circumstance? There's only so much you can do. You don't want to turn the buyer away and have them go to another real estate agent. So you want to play that really close to your chest and say, okay, what do we need to do here to give them service, take care of them, but then be realistic at the same time? So we'll do a basic pre-qualification to start, and then we'll properly vet them to say, okay, you are self-employed, so I won't give you one. Okay, so that's how we do it first off. If they're W-2'd, salaried, we'll play careful and be very conservative, and then say, I really need your documentation. Every pre-qualification that we do, we want to get all the way through underwriting. So what we ask on my team is to, when you're working with buyers, try to get them really vetted ahead of time. We don't want to wait. We want to get the loan fully approved before they even get in your car, all the way through underwriting. That's the main goal. If we're not doing that, you're risking your time and you're risking your resources. Because if you're putting somebody in your car that doesn't have that,
Oh, come on, lady. All right.
if you don't have them completed, then you're going to have potential issues down the road. So anytime that you have somebody in your car, you want to make sure they're fully vetted. And that's what we try to do on every single transaction. Sometimes we're not able to because we may have a buyer come to us on a Saturday morning that wants to make an offer, and then, oops, they don't have a pre-qualification. So Sean, can you get them pre-qualified real quick? Yes, I can, but I'll let you know, okay, they're self-employed. I can issue a pre-qualification if you want to secure the property, but this is not worth the paper it's written on. And you may be wasting your time with this person. I understand that you don't want to push them away. They really want to see this property, but this could blow up in our face, and just make sure proper expectations are set. But we really want to get them done way ahead of time so that when you do take them out, you're not wasting your valuable time, because time is money, and we all want to make sure we're being efficient with that time. So again, we try to get it all the way through underwriting through our True Approved program. My whole team is set up to make sure this is done properly, but it needs the buyer's help to do so. If we tell them to do it and we ask them to do it because it's more beneficial to them and they don't do it, it's hard to get them, pressure them, because we don't want to be too aggressive and push them away. But at the same time, we need your help to let them know and understand the power behind it. If we can make an offer on a property where the loan's done, and all we need is a appraisal and a prelim, and sometimes not even an appraisal because we can get waivers if they're putting 20% or more down, then they're going to have a much better opportunity to win that house and to get that property. And they can close in 2 to 3 weeks because everything's done. The last thing we want them to do is to go through the whole loan process while they're under contract. That just adds stress to the whole equation. And we want the process to be smooth. We want it to be simple, and we want the end result to be positive. So if whatever we can do to protect the experience is what we want to do. We want to make sure that everything's done in a way so that you shine when all is done. When they say, thank you for referring them to the Wolin Mortgage team, it was really simple. They got everything done ahead of time. So once we're under contract, we're able to focus on what's next, not the actual loan. So that's what we want to do. And that's the whole goal of how I put my team together. So thanks for asking that, Valerie. Any other questions? Automated underwriting, make sure you're asking if it has been automated underwriting, because if it hasn't, that's really scary, because it could be an approvable loan based on guidelines. They could have a 700 credit score, and they could have 20% down. And guess what? They may not get an approval because they may have been late on one of their mortgages in the last 6 months, and they could have some overdrafts on their bank statements in the last month. And guess what? All of that comes into play. So just because you fit guidelines does not mean your loan's going to get approved. And that's why we go through underwriting and properly vet everything. All right. I hope that helped. Be very careful when you get a pre-qualification on your listings that you ask the proper questions on that. I'm going to send the notes to you guys so you can kind of see that. And then if you have any questions, I'm going to stick you on this call for the next 10-15 minutes.
Excellent information. Thank you so much, Sean.
You're very welcome, Valerie.
Thank you, Sean. That was good. Yeah, I think it's hard when we get these pre-quals though that come in on offers from other lenders, and then the agents and the buyers are just not willing to send, like a legitimate pre-qual letter. You know, that especially California buyers. Like I had a California lender, and he's just like, don't worry about it, they're approved. I'm like, I know, but I need LSU. And he wouldn't give me, it was just one of those things. And he just never gave me anything documented at all. I'm like, have we done the appraisal? Oh yeah, the appraisal's done. You're like, okay, So I think it is tough when we have to deal with the outside of Arizona lenders, Yeah,
it makes it real difficult. And in this market, there's so many people coming in from other states
Mhm.
it's inevitable you're going to run into these. And there's nothing worse than when you send the pre-qualification letter and the LSU in a blank format to those and they just ignore it.
Right, right. Yeah. Like, what do you
Like,
do, you know?
Like, sorry, no, we don't care about you. I don't care about you because you're not my agent and this loan's fine. I'm not going to waste my time on it. That's their
Right.
attitude a lot of times.
Mhm.
So it's unfortunate. I have to deal with them too, because a lot of times I'll call them to see what is truly going on with the pre-qualification. Some people in California, though, there's some interesting trends, and I always look at California sometimes to see what the future is going to be for other states, because they're just a little bit crazy sometimes. They're sending full automated underwriting results in with offers.
Oh, geez.
Yeah. So they're sending on when there's mortgages, they're sending page 1 of their tax returns, they're sending credit reports, and they're blocking out different things, but they're sending a ton or not enough or nothing. So it's
Crazy.
pretty wild what people are doing over there. But it just goes to show how important it is to make sure when you're making an offer that your buyers are properly represented by the lender and they're properly pre-qualified, because if they're not and somebody else is, you're going to miss out on that offer. So that's the whole point. We want to make sure we're setting up our buyers for success. We're not wasting your time. But it's a team effort, because a lot of times when I call them, when you say, hey, Sean, give these buyers a call, they're probably talking to 2 or 3 other loan officers as well. So they're not wanting to give any information. They're wanting to try to pick one first, see which one they like, maybe see which one's quoting the best rates, and they drag their feet. And then they find a property and it's too late. They're not properly vetted. Their offer is weak because their pre-qualification isn't completed. So it's a team effort to try to get them to get their information in and get it quickly. Also, keep in mind, if people are afraid of having their credit report run multiple times, buyers have a 2-week window where they can run their credit an infinite amount of times with as many loan officers as they want, and it only will show as one inquiry. So tell them to shop quick, get all their stuff into everybody, do it in the same couple hours if they need to, get it out of the way so that we can be properly set up. And then let me worry about the competition. I'm happy to compete.
Yeah, and I just want to make a note of that. I mean, I want to comment on that because I think that this is what I teach agents too, is that like all this knowledge is such a great way if you are holding open houses, right? And somebody comes in and you do ask them, you end up talking to them, are you pre-approved? And they're like, oh yeah. And having all this information is such a great way to engage with a new buyer that might not be talking to you, because it's information that they don't know. They've gone online, they've gone to like a Quicken Loans, which is big, or they've gone to some online, oh yeah, I got a pre-qual, and all this information. If you can tell them also that alone, Sean, adding value, or saying, do you know that you can meet with as many lenders in 2 weeks and pull your credit? It doesn't, like, most buyers don't have any idea that they can do that. So to be able to tell them that and just be like, so what I would do, I would highly recommend getting another quote and getting one. And here's Sean, right? Here's a great one that I work with. And I would definitely, I would recommend getting more than one quote, because those online ones, like you're talking about, like, you don't know if they've done an automated underwriting, you don't know anything. And those buyers are out there and they might want to make an offer on a house and they might be 3 months out. Right? So now they're going to lose a house, and because something's on their credit that they didn't know about, you know? So.
Yeah, no, absolutely. The online pre-qualifications are the most dangerous ones to accept. And you'll see them. They're on a generic form that's printed out online with Chase Wells, whatever it is at the top. And I mean, I can go on to Quicken Loans. I can, as a commission only person, I can say, yeah, my W-2 is this. And then all of a sudden you get your most recent 2 pay stubs and they don't match what your previous 6 months was like. So guess what? Now you don't qualify. But if I put in what I actually made, I qualify. So all of that is garbage in, garbage out. It really needs to be vetted properly. And the problem is when you see commercials like push button, get loan, it gives this false sense of security to customers. They think that it's an easy process. They think that, oh, I can just go on and, yeah, I don't have to do that right now. I can do that when I find a house. I just have to push a button and get a mortgage. Well, guess what? Rockets explode quite a bit. I don't know if you ever watch the news, but there's a lot of rockets out there that go take off and blow up. And that's sometimes what happens with the rocket mortgages.
That's pretty funny.
I'm just stating the obvious. I probably wouldn't have chosen that as my little mascot, but that's my own opinion. So
I have another compliment for you, Sean. So I had a client, a buyer who's thinking of moving to the area, and he said, "So tell me, are they still doing points?" And I'll tell you, I would not have known anything about what a point means or what it does. And I said, well, it depends on what your interest rate you want. If you pay points, it'll go down. Oh my God, he just clammed up. That was it. Like he thought he'd catch me or something. I don't know. But yeah, thank God for you.
well, thank you. It's interesting because if you would have asked a loan officer 15 years ago, do you charge points? It's a different conversation. And a lot of times these people haven't gotten mortgages in the last 10 to 15 years. Back then, a loan officer could charge however much they wanted on a mortgage. They could charge discount points, origination points, multiple points if they wanted to, and it had nothing to do with the rate. So 10 years ago, that all changed when the loan officer compensation changed.
Wow, that's good to know.
Yeah, so now loan officers make the same exact percentage on every single loan, and the mortgage company they work for is what pays them. It has nothing to do with the rate being offered.
Interesting.
So let me rephrase that. No matter what rate is offered, the loan officer will always make the same. If I offer a rate of 5% today and they go somewhere else and it's 4.5%, it's not that loan officer trying to make more on the deal. It's not, because they make the same no matter what. So if a loan's hard, I can't charge more because it's more difficult. If the loan's really easy, I can't charge less because it's less difficult. It's exactly the same on every loan. So points right now in this market, like you said, have nothing to do with what the loan officer makes or what the mortgage company makes. Has everything to do with what the rate they choose.
Really interesting. Thanks. Yeah. Thanks for going in depth with that. That's really interesting.
Yeah, because back in the day, there's people that say, oh, I'll never work for less than 2 points on the deal. And they would charge 2 points on every transaction, and that's maybe $6,000. They'll put that in their pocket and walk away. Whereas now, loan officers make the same comp on every transaction. And we can't change it. We can't manipulate it. So if one lender says, we can't match that, it's not that the lender's not willing to take a less comp to get the deal done. He's not allowed to. So the only way to match that is if the company is willing to not make any money on that transaction, and they're waiving their overhead, or they're not their overhead, their overrides for the company. Instead of the company making X amount of per loan, they waive that just to give a lower rate, because the loan officer can't manipulate theirs, but the mortgage company can lose money on a transaction. And that's where you see the mortgage companies like ours that can price match, because the lender can lose money, but the loan officer cannot manipulate what they're making. Whereas back in the day, 15 years ago, if I had somebody that came to me and said, hey, Sean, this lender's offering me this rate, can you beat it? I would say, absolutely, all day long. I'm willing to make $200 on this just to get the deal done. Where now I can't do that. So there's pros and cons to that, because now people can't get gouged. They can't make, somebody can't take advantage of them. So that's a good thing. At the same time, it's hard to give a really good deal to somebody if they want to. So they have to get the company to come alongside and help them. So interesting conversation on that, Valerie, but we can always go into that a little bit deeper if you guys want to, but it is very different in today's world. So thank you for bringing that up, and thanks for the kudos in the training. I'm glad you're listening.
Absolutely. It's great. All
right. Well, I'm going to stay on for a few more minutes if you guys have any other questions. And again, 9 o'clock from now moving forward, that just doesn't, it's that way it's not chopping up my Mondays, because Mondays are pretty busy with new contracts coming in. And that way we can get it done early and get on with our day and make some money. So you guys enjoy your day. I'll stay on for a few more minutes and have a great week.
You too, Sean. Thanks so much.
Thanks, Sean.
Anytime. Yep, you got it. We'll talk to you guys soon.
Thank you. Have a great week.
I will. You too.